Hey, this is Jeff Scott, and welcome to this review. This is, you see, 2:21 p.m. on Sunday, July 5th, and I think the early Greek returns are that it's a no. So paradoxically, will that be good or bad for the market? It should be bad for the market as it continues uncertainty, but I can't believe anybody's actually surprised. Who's going to vote for austerity when your leaders promise to give you everything? Not going to go there. Try and be clean. This is just a picture outside our recent trip to the Amalfi Coast. My lovely wife overlooking the bay. This, I think, is we were in Positano, or the Positano area. So I titled today On Dangerous Ground, and I think it's there for multiple reasons. Obviously, we're going to have to deal with Greece, a couple of views of Greece. And then for those that are HGSIers, you know what a phoenix means. For those of you who are new to our group, phoenix is an uncommon signal that is sort of the bearish equivalent of an O'Neill follow-through day. And we threw one this week, so perhaps it's foreboding of future market decline. Forewarning, foreboding, whatever. Disclaimer, this is for educational purposes only. Anything recommends is for education, not investment advice. I'm a doctor, not a broker. I am independent. Everything I show you, I paid for. And trading involves risk. You and you alone are solely responsible for any investment decisions you make. And give yourself enough time, you'll lose money. Be your own guru. I started with CanSlim as defined by O'Neill, improved upon by Morales and Katcher and Woodward and Brown. I also am a big fan of Alexander Elder. A lot of my short-term signals, not short-term trading, but how do I go from a watch list, scan it, and get actionable signals with defined buy prices, stops, and targets that I get from John Person, both from an education and mentor perspective, but also from plugins to TradeStation and other programs I use. Volume price analysis, the poor man's version is to buy this for $5, Alan Cooling's version on Amazon, and get the Thinkorswim volume price analysis tool and save yourself several $1,000s from buying an expensive program. Van Tharp for position size and money management. Dorsey, I'm not a point and figure guy as much as I am a comparative relative strength guy. And lastly, George Lee, my partner at our recent meeting and a great trader from Canada. I have a lot of programs. I try and remember to hide my desktop so you can't be counting them, or my wife can't be hearing how many I have when people run into her, like at barbecues at my house. But basically, I need TradeStation or Thinkorswim. I also use Genesis, which I think is the best intraday platform. For analysis, I'm all about HGSI and EdgeRater. I do seasonality through multiple programs, and I follow a number of websites. Market thoughts, we are clearly close to a top. Whether we're at the top, I think you can only call in hindsight. But regardless if we're there or not yet, we are getting close, and there's multiple pressures to bring this market down. The major theme really is Greek vote today, whether it's exit, compromise. It's interesting, they're sort of crapping in the face of the European leaders by saying we're not going to accept your conditions, and oh, by the way, the people are behind us. And I guess there's feeling in the Greeks that that's going to cause the Germans to capitulate. Will it be interesting to see? Personally, I think the Germans will capitulate because the Europeans are benefiting from a weak euro to dollar. And although there could be some market disruptions with the Greek exit, Greeksit, or however it's defined, long-term getting a weak player out of the euro might cause paradoxical strength in the euro, and that might be something that is worth paying them off to keep them in the euro. Chart review, boy, was it hard to find great setups for the long side. Yield matters again as rates drop. Good for REITs, utilities, dividend payers, MLPs, bad for banks. Leg down for oil continues with pressure on elements of the XLE, OIH, and XOP. Financials were under pressure. The XLF, which are both big banks, regional banks, broker-dealers, although there was some strength in broker-dealers, and insurance companies, especially on Friday, were weak. Leadership, it looks like a good offense, like in football, may start with defense, with utilities, REITs, bonds, tobacco, dividend players leading on my top-down review. Just to get an idea of the market on Friday, and I'll show you multiple different glimpses. I think overall the market was not nearly as bad as it may have felt for a growth investor. I think growth definitely was out of favor this week. You can see strength on Friday. You see a lot of technology and semiconductor names with mostly green. Utilities were almost en masse green, as were gold miners, as these were perhaps havens that people sought, especially gold and utilities, and I already mentioned tobacco in the setting of market concern. Now, this is sort of my market story. And just to walk you through, I've got four major six major markets, or four markets, a dollar, and the VIX. There's a green is the 17, the yellow is the 50, the red is the 200-day moving average. Up here is the S&P 500, here the S&P futures, and you could see it tested the 500-day moving average, the 200-day moving average, which was the first time until we go back to, I think this is November. That was a big test here. We have the NASDAQ dropping below the 50 but well above the 200. We have the Dow also tested, barely got back to the 200 by Thursday and closed below it on Friday. The IWM looks like the NASDAQ, it's broken through the 17 and the 50 but still well above the 200. We see the VIX breaking above the 50 and the dollar also starting to move back up. So you look at that and clearly you should get the feeling that this is not a market that is rah-rah and that we are at critical support, at least on big stocks. The other thing to point out is that there's sort of been a battle between risk on, risk off, high rates, low rates. And with the market, as we get into a risk off environment, or actually I guess risk on, as the market gets less risky and we focus on strength in the U.S. economy and potential for rising rates, you'll see interest rates rise. When interest rates rise, that's good for banks and insurance companies. It's good for borrowers, for savers who have money in the bank. When rates fall, it's good for people that take loans. So whether you are a MLP, whether you're a utility, whether you're a REIT, somebody that pays a big dividend in a falling rate world improves the value of your entity. You can notice here that rates ran up, and you sort of got this fulcrum here, which has been resistance or support in the past and looks like it's now turned into resistance. So at this point, rates, if anything, are at resistance. They actually gave up some from there. I've talked about this forever, and just take a look at any utility and tell me you don't see that pattern. You need to know where we're at. Clearly, we are in this period of uncertainty, and I think the risk is rising that we're actually moving into stage 4 fear, and that might be at some point, sooner than later, we're going to see some fairly significant market declines. You have to adjust how you trade based upon where we're at. I put some of my favorite trades, and to me now it's getting rid of positions, taking smaller positions, raising cash, and selling premium. But I'm starting to get more bearish in my thinking as I look going forward. You got to know your news and your earnings dates. As you could see in the charts, there's not a whole lot of activity. Not to say that the jolts and the mortgages and the inventories, and especially on July 8th, the FOMC minutes, not to say that they're not important. But I think the big news is both Greece and the not nearly as oft spoken about the Puerto Rico debt issues. I don't think the FOMC minutes will be a big shocker because if you remember, that was when Janet got up and she was extremely dovish and sort of took June off the map. And I think now our people are wondering whether September for an increase will happen, especially with what's going on in Puerto Rico and Greece. And let's not us forget, we're one of, if not the largest debtor countries out there. Our GDP is stronger, our country is stronger. There's a lot of reasons why we're not Greece or Puerto Rico. But if interest rates went to 7 or 8%, I think the government gets hurt more than anybody else because of our debt payments. As usual, top-down review, market, sector, stock, and a little bit of bottoms-up depending on my strength of my voice and how long it takes to get there. we've completed my meeting in Singer Island. It was great. Thanks to everybody who took the effort to get here. Next on tap for HGSI users will be the PV meeting with Ian and Ron. Unfortunately, I have a wedding that weekend, so I will be missing that one. The weekend before, Greg Mills has a program in Anaheim, and if I'm asked to speak, I'll be speaking there. And I just want to call out and thank my guests, Lowry Research. Jordan from Lowry Research came and gave a great talk about how they look at the market from a top-down perspective. And I sort of forced him without warning to go back to a prior presentation and talk about what market tops look like. John Person, I mean, talk about crazy and talk about what a friend does. He left to go out of town for a week on Sunday, and he actually, during his packing, he came over and spoke for an hour to support me. Chris White from Edgerator, and then my co-host George Lee. And hopefully next year we'll see you in Florida. I certainly plan on holding additional meetings. I say that, but my non-competes from my healthcare services business world all expired on July 1st. And to say I'm sort of raring at the bit to get back in the workforce because I miss doing some of the things I've done in the past would be an understatement. So we'll see what happens. I'm actually hitting the road in the morning to start to build another business. So, but for those of you who are new to me, I've done this for years. I've only been retired for 2 years, and I really have concentrated in the past of trying to understand how to trade while actually holding down a job and how I use the tools because you can't be by a computer all day. And frankly, even though I've been free the last 2 years, I'm not a big fan of just sitting in front of the computer. You know, John basically, person, I spend a lot of time in his office until about 12 in the afternoon, and then we go to lunch. I just think sitting by the computer every day, constantly, is not for me. I'm sure it's for a lot of people. So let me open up my end of week spreadsheet, because that sort of gives me the lowdown of what I'm looking at in the market. So I didn't do my usual routine of saving groups, so I can't really comment on individual groups last week. I was sort of preoccupied with my meeting. But I can talk a little bit about what I see in the major markets on my review. And while that's opening, let me just pull up Genesis. So this is one of my favorite screens of Genesis, and what I have here are E-minis, the NASDAQ future, NASDAQ 100, the TFs, which is the Russell futures, the NYSE, which won't be trading today, and the Dow futures. And I usually have it set up on a short time frame up top, and then daily and weekly going down. So let's change the short term to a minute, and you could see that for reasons that I don't totally understand, on Friday, of which the market was open for a short period of time, the futures actually had, I mean, it looks like a big move. It's probably it recovered some of where they had been before. Not really sure what to make of that. But I will say, as you look at my weekly charts, I'm still in a daily buy rather on the, oops, sorry about that. A daily buy on the E-minis, but I'm on sells on the daily on the NQs, the TFs, the NYSE, and the YMs, the Dow. On the weekly, I'm on a weekly sell pretty much on the E-minis, the NASDAQs, the NYSE, and the Dow. I'm still holding on to a weekly buy signal on the Russell. And I guess it's not surprising that the NASDAQ on the daily and the Russell on the weekly are different than the others, and that's because that has been where the strength in the market has been. So let's look at what happened last week. So I'm going to start with sort of the week return view. And what you can see here is that I just took the major indexes and I looked at, had I bought the market on the Saturday before and sold it on Friday night. And what I found was that the S&P was up 0.93 for the week. I don't think my portfolio was up 0.93. In fact, I'm sort of shocked by this, although we did have some good moves midweek. If I look at what's probably more reflective of my world, and you look at the indexes, the Russell's lagged, and the Russell was up 0.12%, S&P 600 was up 0.5%, gold and silver down a little bit. Volatility for the week actually dropped, which is hard to believe, but I think it ran up and it ran down, although who wouldn't be surprised to see volatility come back into the market this week. Utilities, no surprise, were up 1.62. The dollar was up over 1%. The NASDAQ 100 was up 1.22. Semis were up, and then you got the S&P 500 and 100. The Dow as we move down. So strength in the S&P 500, more so than the small stocks, although over the last several weeks, I think it's been the small stocks that have been leading. Hindenburg. So on the left, we have today, and on the right, we have 2007. So there's a couple things I wanted to point out. In December, we had a number of Hindis hit of 2014. But since then, we've had spurious Hindis, 2 of them in early June and none in about a month. So right now, I'm going to have to consider the Hindis to be non-influential. But I'll be looking for those, especially if I think the market's topping. This is what 2007 looked like, where you had a series of Hindenburgs here in July, and then at the second top and the final top in October, November. So it's that pattern of multiple Hindis within a 3 to 4 week period of time that really is going to raise my ire as to whether or not I think we have a big correction coming, which I do, and we'll see when we get that, if we get that. Here's another view. This is where we were in 2007 and 2008. Now, I've commented a couple times, and I wanted to explain my comment about change in some of the tools that we have and what's being measured and how that might impact the Hindi. The NYSE is not really a pure index by any means, and it's what's followed in the Hindi calculations. And the current NYSE generation that we have, the all NYSE, has a number of preferred stocks, bond funds, interest rate sensitive instruments that really do not reflect the overall state of the market. There's also the bar chart NYSE, which is available to HGSI now, which may be a little bit cleaner and certainly has different makeup than the old all NYSE. So what I've done is I've created a view that's got both Hindis, the bar chart on top and the all NYSE on the bottom. And you could see the bar chart really wasn't available to us back then. And you could see the series of Hindenburgs that occurred within HGSI at the market top. Now, if I look at today, you could see uptrend occurs, and we're starting to see a few Hindis coming in as we get up, and certainly looks like the momentum is slowing. And you notice that on the top is now what's firing, which is the bar chart. So I think I'm going to leave both of the indexes calculations on the charts from now on, because I don't want to miss a potential Hindi, because Hindis can give you a signal that it's time to raise cash and become more defensive. One thing to point out, there's a big difference between where we are today and where we are as the second Hindi fired. We are still trading above the 200-day moving average. And I always look at that as being bullish. When the price is above the 200 and the 17-day moving, the 50-day moving average rather, is above the 200, that's bullish in the market. And we are still in a bullish, biased market. When we go back here, we already had issues with the 17 crossing, the 50 crossing the 200. We had multiple breaks of the 200-day moving average. We had a retest. So it does not look alike today versus 2007. The other thing to point out is even if you do very little market timing and you have a bias to the long side and never short, never buy contras, and like to stay fully invested, as I look at this, I can't say that I really want to be in a scenario of being long when the stock market drops below the 200-day moving average. And as I mentioned in the beginning, we're perilously close. bucketology, this is where we sit, over 2/3 below the midline of the S&P 500, and clearly shifted to the left, although not as bad as we've been. If I look back on the 29th, which was a week ago, you could see that we had over 30% of the stocks trading below the Bollinger Band. We had a little bit of a bounce, but the problem is we're really much news dictated with what's going on in Greece, although despite all that, you saw the markets were up. And then here's the buckets going back a week before that, and you could see how we had 14% above. So very quickly in this choppy market, going from a bounce and a resistance picture, and we sit today in a overall, I think, bearish pattern. Speaking of bearish patterns, on my markets profile here, I should use market profile, that's a different term. I'm looking at percent B, percent one-day change, percent B, and then Woody's indicator. And let's just look at Woody's indicator, which is decisively bearish. And then I'm not going to spend much time on Georgia's setups and Edge Rater, weekly or daily, Morales, code blue, and code red. If I was looking, however, to find stocks to short, I might be looking at Morales' code red and taking a look at some of the top stocks here, and you could see some of the regional banks under pressure with KRE making it to this list. From a seasonality perspective at the market side, let's just look at here the 1 month. Volatility has been up over the next 30 days in 14 out of 20 years with a volatility increase of 12%, and really nothing here that shows me any substantial expected move in the market to the upside, and that this period of time has been weak, as you could see on small caps and then semiconductors. If we go back and look at individual stocks, you will notice that there are some stocks that have a good rate here, 18 out of 20 times in the next 30 days. Amgen's up. Apple, 15 out of 20. So you can see there are stocks that might have an anticipated positive mood coming up. If I eliminate, and just look by, I eliminate anything with less than 8 years positive and more than 5 years negative. You see that Infinity Pharmaceuticals is up 11 out of 14 years with an average return that's sort of ridiculous. I'm sure there must have been a story there. Baidu is up 8 out of 9 years for 13%. Array Pharmaceuticals, Seabridge Gold, there's Amgen. How I use this is it gives me a sense of the overall market. And I'm also looking for stocks that have 80 or 90% movement one way or the other. And you can see, for example, that this is interesting. The China index, FXI, has actually been up 9 out of 10 times over the next 30 days. And this is on the heels now of a pretty substantial reduction. But if you could get a 30-day move of 5% in an index ETF, that might be a big move. Let's look to the downside, see if there's any signals here that we might care about. Now, you're not going to see them here because I eliminated all the bad actors. So we looked at that. All right, so let's shut this down. All right, let's look in TradeStation. Let's look at some of my things here. Market force and divergence. So let's specifically look at the indexes. And I like to look at these looking at some of the signals from John Person as well as from Alexander Elder. Elder is looking at color of the bar. And if the bar is green, then it's okay to be long or short or hold, but you should not short. If it's red, it's okay to be short or holding, but you shouldn't be long. And if it's blue, it's trader's choice. I also look at multiple time frames, daily, weekly, and monthly. And I look for evidence of a MACD divergence, which we're not seeing right now. I saw one on one of the indexes. It could be a divergence if there's a little dot at the top of the price bar. It could be convergence if it's a dot at the bottom of the price bar. And then I look at the person signals, which are these magenta for a sell and cyan for a buy. And I look at high jump. So NASDAQ in a trading range, at the lower part of the trading range, it did turn blue on the weekly, but it's daily, but red on the weekly. It is on a person buy or sell signal, and I consider the NASDAQ still weak. This is maybe one of the places to wade into if you want to be long the market. The Dow and Jones Industrials had a deeper sell-off. trading in the lower part of the range, also blue, so you do have permission to consider buying, but you're in a person sell signal at this point as well, and a weekly sell on Elder. The OEX, or the S&P 100, looks a lot like the Dow. Lower part of the trading range has turned blue, red on the weekly, in a weekly sell. Semiconductors, again off the bottom, turned blue, but still in a weekly sell, and on a weekly sell by John's indicators. Here's a cash S&P, looks a lot like the E-minis, as we'll see in a second, coming off the bottom of the range in a sell signal. Here's the E-minis, bottom of the range in a sell signal. NQs, bottom of the range, sort of a neutral blue signal there, and on a sell signal, but sell signal on the weekly on Elder. And then the Russell futures, decisively red on both daily and weekly, in a sell signal. I don't see how anybody can be bullish here, and I think the market will bounce at some point. Maybe the market bounces on this news because now it's pretty clear that, well, not pretty clear of anything, because of the discussion coming out of Greece that they expect a deal very quickly now that they've got the country behind them. I still doubt that. I don't see it, but I see no reason here to want to be aggressively to the long side in this market based upon what I saw here. Now I'm going to look within HGSI. Whoops. And let's go into warehouse view. And let's go to, close this thing. User groups, major markets plus. Let's look there, and let's go to top-down view, which looks at predominantly yesterday's or Thursdays in this case, plus a little bit of 5 days, plus a little bit of 2.5 weeks. And again, as we saw earlier, by ranking the weaknesses in the small caps and mid caps and the Dow Jones and the S&P, all the instruments that we trade are down here. This does look different than that spreadsheet in the beginning, but remember the spreadsheet was looking at 5-day percent return, and this is heavily weighting Friday, the last day of the week's return, which in this week is Thursday. Let's look at some for specific interest. Let's start with the S&P 500. It's never good when the dollar and volatility are leaders. So I want to introduce you to a new friend or an old friend called the Phoenix. And let's see if I can't find you the definition. The Phoenix is not seen often. It's sort of the bearish equivalent of the Eureka, and the Eureka is the HGSI signal that sort of puts the O'Neill follow-through day into an easily monitored tool. So let's see if I can't. So by automating it, the hope would be that it would make it easier for us to see. So let me, it's just my presentation, some of them that I did at the meeting. And a lot of these come from Ron and Ian, who I always like to call out and thank them for all the work that they've done in helping me make money and learn how to trade and allowing me to use their stuff to help you. So a Phoenix is the follow-through day to the downside. It's typically could signal the end of a run and a market top, or that a correction is coming if we don't reverse it quickly with the Eureka. And you can see it's made up of advanced declining issues, volume, and the ARMS index. We have a number of different settings. The darker the color, the more severe. And you can always stop the video and watch that if you need to take notes. And you can see here that we had a dark one here, and we had a kahuna to the downside. So the Phoenix is calculated on the NYSE, as is the Eureka. It may show up on every one of my charts, but we only really monitor it, or it's only measuring the NYSE no matter what chart I'm looking at. So now that we know we have kahunas to the downside and a Phoenix, let's go off of this and just look at moving averages. and let's take a look at where we've been, where we are, and where we might be going in this market. So the first thing to point out, as we all know, that since March of 2009, we've been in a relatively massive uptrend, and an uptrend that's hopefully gotten you back beyond to even after the 2007 drop, and hopefully you've grown your nest egg quite a bit. But you can see we've had a return of over 200% in 6 years, so averaging about 30–35%, which is very big. Other thing I see is that in the early parts we tested the 200, we dropped below the 200 in periods of time, but really since this point here, which would be late 2011, we've really had a fairly massive 4-year run, and we've been above the 200-day moving average for, here's a gain of 63% in the last couple of years after coming way off the bottom. And we've had a couple of kisses of the 200, a knife through it back here at the end of 2014, and it looks like we're getting very close here to breaking through, once again, the 200-day moving average. And I don't think that's a good story in the market, and one that I'm going to be watching. I have no problem being long in an uptrend. Problem is I don't know when a downtrend is going to stop. And if we look at where we've come from, and you look at that last bad correction, this is in 2007 to the 2009 low. I don't want to be long. I certainly don't want to be margined, super long, leveraged long at all when that stock market trades below the 200-day moving average. And what we don't know is how long it will be below if we drop there. So I'm on 200-day break watch. We held here on the S&P, and if we bounce back up to retest highs, that's very great for the market. With the news coming in and the concerns, I think that there's a relatively high risk of us breaking. Now, where is support and resistance in this market? Oops, I don't want to draw that. I mean, we've been in a nice uptrend for some time. Let's just play a little bit. And that might be one. It's probably more like it. We've dropped below that. But there's somewhere in here, there is a right marker to draw that somewhere in here, probably down in this range here, is my target range. And if we break below that range, then I'm going to be very concerned about where this market goes. Now, the top of that range is the 200-day moving average. As long as we stay above that, I will be somewhat bullish and aligned towards the long end of the market. But I have lightened up considerably, and this is not a place that I want to be super long, high margin, because this is very, very risky, extremely risky position. If I look at the Dow Jones Industrial Average, this is what I drew before as my target. We came right into it and bounced. Will this hold a retest, or is Greece going to pull us below my range, which is going to be bearish for the market? If I just break down the components and look to see if there's been improvement, transports are just bouncing off the bottom. They've had one bear flag after another. And is this another bear flag setting up? I don't know. Can't be real excited about the transports, although I will give them credit. They went up at the end of the week. And on the utility side, also down in the dumps, but a big move on Friday. And I think certainly we're seeing that utility stocks may have some life in them right now. Let's look at the NASDAQ. Almost. And the NASDAQ has broke through what I thought would be support. It's still well above my next level of support and the S&P 500, which would be my third level of support. tried to get back above that support line. It's below the 50. I think at the minimum, I say the NASDAQ is under pressure. It certainly looks stronger than the bigger stock indexes. And if I look at the Russell 2000, again, still above my area here that I thought would be support, but testing it, although like the NASDAQ, well above its 200-day moving average, which would be the thing down here. All right, let's look at, so the other things, we look at volatility, got above its, this had been pretty strong resistance, and it took multiple shots to get above it and break above this 200. Failed here, 1, 2, 3. We made it on this attempt. It also held as support. Sometimes resistance holds at support. A rising VIX is very bad for your portfolio if you're long. A falling VIX after it peaks is where you make most of your money. So do we get a VIX spike this week with Greece on Monday? And does that VIX spike lead us into several bounces on Tuesday, but turnaround Tuesday and potential to find some big movers as VIX comes back down to normal? Rising VIX isn't great for stocks. A rising dollar, not necessarily great for stocks. We've been going sideways in here and still within the trading range in the middle, but did move up this week a little. If I look at gold and silver, with the dollar moving up, one might expect gold to be weak, and gold did sell off most of the week. It had a nice day on Friday, which I'm going to throw into the category of being defensive. Hard for me to be long gold until it gets above the 200-day moving average and stays there, and it's failed multiple times. And then silver, which has a little bit more utility, industrial use, looks just as bad as gold. All right, so hard to be excited to the long side of these markets. Let's take a look at industry groups. So we're going to go down to 07, and I can see I have 175. Let's look at which ones are two-day EMA up. So what's moving up? As I said, look for defensive plays. REITs, utilities, insurance, metals, refiners were up. Casinos, MLPs, marine shipping, big dividend players, tobacco, all made the list of strength. Let's very quickly look at some of these. Now REITs, sometimes I think a REIT is more meaningful based upon what interest rates are doing than the individual company. But as I went through this, there were several REITs that looked to me like they would be reasonable things to start buying. The concern about REITs are when interest rates do start to go up, you need to be selling them or being careful. Here is equity residential as a good example. Big run up with the rising rates. It pulled back. It's now sitting right near the 50 and the 200-day moving average. Had a pocket pivot on Friday at Kahuna on Thursday. Pays a 3% dividend, has good earnings enough to support its dividend payment. Here's Host Marriott, beat up as well, kind of bouncing off the bottom. Good earnings per share growth, 3.9% dividend. Digital Reality Trust has broken above, out of a squeeze and above its moving averages. Multiple pocket pivots in a Kahuna. Everything is green. Great earnings per share growth, pays a 4.9%. DLR, that might be one to look at. American Tower, again, same pattern, doing nothing sideways, trying to move up here. Avalon Bay, another REIT. It's an expensive REIT. They own a bunch of apartment buildings and others. Great earnings per share growth, pays a 3% dividend. Pull back to support. Now it has some momentum coming in. So I look at REITs and I see stocks or entities that have pulled back to support, and the market's favoring them now and they're moving up. I mentioned, if you don't believe that little bell-shaped curve, let's take a look at utilities. This is Duke, and all of these utilities are the same thing. They are bottom fishers in my mind, or they're bottom fishing time. So just look at a weekly, and here's that pattern, run up and come down. All right, and this happens time and time again when the group cycles in and out of favor. So utilities right now are in favor. This is Duke, sort of coming off the bottom with a Kahuna. It pays a 4.4% dividend. Nextera, been basing a little bit, but also coming off the bottom with a Kahuna. It pays 3.1%. Southern Company, well below the 200-day moving average, a nice move up. Have to see it get above the 50. Did have a kahuna, pays a 5.1% dividend. Same pattern, Wisconsin Energy, coming off the bottom with 2 kahunas in a row, pays 3.6. Not very sexy picks. Do your research, but right now utilities look in fuego. Property and casualty, these are probably moving because Chubb is being bought by Ace, and you could see Chubb popped up on Thursday, gave back, actually moved up again Friday off Thursday's low, and here's Ace, also had a big up move and pulled back on takeover announcement. Beyond that, Hartford Insurance Group, let's see if Heritage is here. To see if there's anything interesting. Big move up on Thursday, gave back a little bit on Friday after their kahuna. It's got some earnings, pays a 1.6% dividend. And here's Travelers, pays a 2.5% dividend. All right, next group down, Precious Metal Mining, not a group that's been a leader. And Newmont actually did look interesting on the charts. Again, pull back to support here on the 200, trying to break out above. OBV is down, earnings per share growth tepid. Not a big fan right now, but gold and silver, probably because of the market concerns actually having a decent looking week. Here's Gold Core. Certainly hard to get excited by these gold stocks. Refiners and marketers, they pay a dividend. This is a good time of year for them. They make money on the crack spread when oil drops and what we pay for gas is going up, which is what it's right now. This may be the best looking chart of the bunch. Tesoro Petroleum, TSO, has been going sideways since February. Broke out with multiple pocket pivots and the kahuna on Thursday, up day on Friday. Everything is green. Good earnings per share growth, at least next quarter, pays a 2% dividend. Valero, one of John's picks, same basic chart with a doji on Friday after multiple pocket pivots and a kahuna, pays 2.5% dividend. Holly Frontier, again, breaking out. Pocket pivots and kahunas, everything is green, 2.9%. And Marathon Petroleum, same pattern. So if you're looking for a place to get some dividend yield on a good chart pattern off of support, these refiners look very interesting here. Large pharma, again, another defensive play on big dividends or what used to be considered big dividends. Their prices have gone up, their dividends have not kept pace. So here's Lilly, kind of a high base, trying to break out up here, all green, pays a 2.3% dividend after years and years of patent losses and clinical trial losses or failures. Lilly really looks interesting right here. It's had a number of new products come to market with good potential and looks like it wants to run here. Novartis, not nearly as pretty, just pulling back to the 200 and moving up, probably a low risk entry with a kahuna. And here's Bristol Myers Squibb, sideways, trying to break out here with a kahuna, pays a 2.2% dividend. Boy, it's easy to look at the longs when there aren't that many. Apparel footwear, Fossil's been beaten up a lot. Actually looked kind of interesting when I looked at it earlier. It's still a $70 stock. You could certainly argue that it's double bottomed here. And perhaps you could even come in here and put some kind of a stop right below that line. And on the kahuna on Friday and pocket pivot, figure out why they had that. So let's go to more info from Webb. Finviz. Watches. Analyst upgrades. So Fossil is pulled back to support. No dividend, but it's been a high flyer. You can see the group index looks great, lower left to upper right. On the weekly chart, you can see, again, pulling back to support. This is a weak market. I'm not chasing things that are falling knives. This one, you actually have a 6% or so risk to buy if it takes out Friday's high, with a stop sort of below that double bottom, and then you wait and see. You'd expect it perhaps to fill this gap, and the question is whether it can get above the 50-day moving average. Nike, great performer, lower left, upper right, tight, best, one of the better chart patterns out there. Earnings below multiple, but still a big leader. Skeechers going sideways a little bit, perhaps with a PSR breakout out of a squeeze and a mobile breakout on a Kahuna, giving you a new buy opportunity. Great earnings per share growth. Not a cheap stock, but perhaps priced to move. And then VF Corp, without the same earnings power of the last one, a pullback and break now above the 200, recently broke above the 50. Multiple Kahunas and pocket pivots down here, turning green, OBV turning up. I like VF Corp here as well. Low risk buys, set your stops. Consumer finance, probably a lot being driven by the acquisition or the offer to acquire Zoom by PayPal, which will be spinning out. And this was actually very bad for Western Union, as some consolidation and competition might be feared as risky for Western Union. So Zoom is now a buyout, so it's off my board. Visa, sideways, perhaps setting up an opportunity. Springleaf Holdings, similar pattern, sideways, couple of Kahunas coming in. I don't love the earnings per share growth in this group, but they are sideways and look like they're setting up. Number 9, integrated oils, one that's led by BP. Yeah, I mean, this is an interesting story. BP was up 5% on a week tape Friday. The integrates, which have refiners and marketing and their own oil and gas, they made this list where you don't see exploration stocks. And maybe it's being driven by the refiners. But BP maybe should be in your portfolio. They came off, had a big settlement on Friday, or a settlement announcement. And perhaps that settlement will take some of the headwinds off the stock. Probably why it had a Bible, well, not a Bible gap up, but a gap up on Friday. Kahunas and pocket pivots. It pays a 5.8% dividend, and maybe it's done going down. So BP looks interesting. There's also been a lot of chatter about potential takeovers. ExxonMobil has been the potential takeover. Chart did not have the 5% move that BP had, pays a 3.5% dividend in a downtrend. Sasol, a Norwegian firm, I believe, I agree, and then Royal Dutch Shell. So patterns don't look great beyond BP, but several stocks in that group showing up. And then I'll look at the next couple. Casinos and gaming, I know Wynn looked great. Let's take a look at Las Vegas. Not great, but let's take a look. Gapped up on Thursday, 2 Kahunas in a row down here. Still in a downtrend, well below the 200, doesn't make earnings. It's all about Macau numbers. I'm not that excited yet. And Wynn also, went up to the 50 on Thursday and stalled. Similar story. Kahuna's pocket pivots, all about Macau numbers. I'm not impressed yet. Maybe getting close. And MPEL is all about Macau. It actually looks better where it broke above the 200 after its Kahunas and pocket pivots. What else do we have group-wise? Marine shippers. Something that we discussed at my meeting is you have to recognize that not all shippers are the same. The dry bulk shippers are in the loser list. So if I go to the force 2-day down, well, not too many of them there. So most of the dry bulks are losers. These are oil tankers, and the reason why they've been hot is that they charge about $1 per barrel per day to sit in the Gulf, filled up with oil, and with the producers producing more than it's being refined, it basically sits there, and the producers are betting that oil prices will go up in the future, so pump all you can now to take advantage of that. Well, right now they're paying rent, and we can look at several of these, and you'll see some nice patterns, and more importantly, some great dividends. TK pulled back to the 50, had a Kahuna on Thursday, didn't give much anything up on Friday. Great earnings per share growth, pays a 1.7. Here's another TK, less impressive of a chart off of the bottom, pays a 2.9%. You have to do your own research and figure out which you want to be. I like NAT, about to take out prior highs, great earnings per share growth, and pays a 10% dividend. I like Scorpio Tankers, about to take out prior highs, Great earnings per share growth, pays a 5% dividend. KEX struggles off the bottom, not doing much. A laggard, we might call that. Other groups in the top 10 or 12, MLPs don't like the chart patterns, love the dividends. Here is Equity Transfer Partners, uptrend, pull back here, going sideways. OBV still down, pays a 3% dividend. Williams Companies, this one broke out here. I don't know if there was acquisition report. You'd have to do your own history or do your own review. Good earnings per share growth, pays a 4%. Spectra, in a downtrend, pays 5%. Magellan Midstream pays 3.9%. So chart patterns aren't great. People are flocking to them with falling rates and for defense and return. So that's to the long side. To the short side, managed care. Kind of interesting because there's a ton of M&A. This is probably all pulled back by my favorite stock, Centene. It put in a bid to buy HealthNet, and originally the stock traded up. In fact, it had a buyable gap up, and then concern became that perhaps there'll be a bidding war and they'll overpay. So I'm actually going to I shouldn't say that. I'm going to add to my Centene position, especially if it pulls back to the 50. I'm not going to buy it yet, but what I'm going to do is I'm going to put it into trading windows. Did I kill that by mistake? All right. So this is now a daily, weekly, and monthly, and what I probably do during the day is 15 hourly and daily. And I'm not ready to get back into this stock yet, but I think it's well overdone, and I can go into a 15-minute chart. I can see it starting to base. And if I can get it to base and then break out with buy signal, OBV is already turned up again. I do want to get back into it, but on a daily chart, it's not ready yet. So Centene, I'm going to be looking to get back in, but it fell hard on Friday because of an acquisition. Now, Humana was also down on Friday, but it's going to open up big. It agreed to be acquired over the weekend, I think, by Aetna. We'll see if they both move up. And then Anthem and Cigna are locked in a tangle, and I think it's not about price, it's about who's going to be the boss. So we'll have to see what happens there. So these guys are weak because of sell-offs and concerns about being paid too much money or paying too much money. It'd be interesting to see what happens there. Banks, regional banks looked weak. You can look at any of them you want. I think I'll just look at KRE. And you could see that regional banks pulled back some. Not horrible. Here's one that I own, had a nice run. Ozark, I think I got stopped out on it on Thursday. Regional banks weak, partly because of Greece, but probably mostly because interest rates are coming back to life. Don't think I want to be short much in there. Communications equipment. Juniper pulled back below the 50. It had been on my bullish list. A failure at the 50 and a turn back down might make it interesting as potential shorting. Right now, I'm not jumping on my shorts either because the challenge is if Greece gets resolved this week, then you might see the markets rise. So I don't think it's a guarantee this market's going down. I think the point is that there has been rotation into defensive and interest sensitive plays, and that biotech is down a lot. Let's go to 5-day down. I think we'll see biotech there. Semiconductors, oil exploration, airlines, services, biotech have all weakened considerably, and those had been leading the market, and it'll be interesting to see where leadership in this market will come from. What else do I do? I look at a lot of scans within HGSI. So let's just set my view in scorecard, combo, no filter, all stocks. So what that's going to require is finds top stocks based on technical and fundamental. It requires on the filter that you're not a group index, and the scorecard ranks you for a number of things. White body, volume, industry change, relative strength, return on equity, so both fundamentals and technicals. And let's just vary what I put into the box of what I'm going to scan for. Let's go up to my smart groups. And I might be interested in, I don't think I am based upon what I remember, stocks that had a big move this week. So I could look at 3X, where we already looked at Zoom and HealthNet, their acquisition candidates. I am interested in Progress Software. They had an earnings beat. Now, when you look at the chart this way, it looks like it's long gone. But in reality, the gap up was, the stock was up $1.75 or 6%. This is a viable gap up. When I looked at my best trades of the last 2 years, many of them were viable gap up trades. So there are rules from Morales and Katcher of how to play this. I might stick a buy above the close on Thursday rather, and put my stop maybe a percent or two below the bottom of that bar. It looks extended, but it does meet the criteria for a viable gap up. It had kahunas the day before the gap, pocket pivots, mobile breakout from a squeeze, everything turning green. Don't love the earnings per share growth, but I think Progress Software looks interesting. I might look at stocks that have pulled back to the 50 and had a kahuna. We looked at BP as one that I was interested in. A lot of strange things in here. I don't know what KKR looks like. Asset manager. So KKR sort of sideways here, but two kahunas coming in a row, a move above the 50, a mobile breakout from a squeeze, mostly green over there, pays an 8% dividend. KKR looks interesting. Now, I'd put my buy stop if I wanted to play KKR. I'd put my buy stop probably above that PSAR dot, and my sell stop probably below where that line is right there. So I'm risking about, $1, about 5% risk. I do like the fact that it pays a nice dividend. And if I wanted KKR, I might look at my current holding, which I like a little bit more, which is BX, which pays a 9.33% and had been growing, recently pulled back. I'm looking for momentum to come into that one. I might look at my squeezes with a PSAR dot right above the close, which might be pre-breakout stocks. Let's just take a look at a couple of these and see if anything here looks good. And this is how I basically do my nightly reviews. I go through some of my better lists. So here's WNS, that is a Nancy Limited. WNS is the ticker. Earnings per share growth tepid, but we've got a stock that's formed a sort of a shallow pan cup after it broke out here with multiple kahunas, rising OBV. So this might be a trade. And what I might be doing here, this is my get on a plane trade, as I like to call it, because I get on a plane a lot. I like to do my trades. So here's how I would handle this. And I'm just doing this not because I'm suggesting that you do it. I'm doing it because I want to give you a taste of how I look at a trade like this and how I can take this trade and get on a plane. So I'm going to start with opening up that. Okay, bring my text back here. So I'm going to call it a example get on a plane trade. Setup. Basing. Here I'm calling it a squeeze. Stock in uptrend. Pull back to support even better. PSAR dot immediately above price. Trigger. Price trades intraday. above PSAR dot. Stop. Look for natural position to place stop based upon technicals. Prefer no more than 4 to 6% risk, especially in this market. On initial stop. Buy, stop, number of shares equal to by risk allowed per trade divided by risk this trade. So let's do some numbers. It closed on Friday or Thursday at 27.42. The parabolic SAR is at 27.50. So I'm going to put a buy stop at 27. Once filled, initial stop placed at. And how your broker does this for you and how you do it in one order depends on your broker. So let's go back here and say that my initial stop, I have a couple of ideas. I might look, so this day's low was 26.41. This day's low was 26.39. This day's low was 26.44. But I've got a major moving average, and that 50 is at 26.16. So let me go back to my, so I'm going to put a stop at $26.10. So my risk equals $1.45, which is approximately, let's get out my trusty iPhone. I should know how to do this in my head, but all these webinars make me a little brain dead. Just kidding. If anybody wants to make a joke, keep it to yourself. So I'm going to take $27.55. Well, actually, I take $1.45 into $27.55. So it's about 5.2% risk, right in my spot that I want to accept the risk. Is it rational? Yes, right below the 50-day. A break below here means I want out right now since trade has failed. How big? My risk per trade is, say, $5,000. So my position equals $5,000 divided by $1.45 equals it's 5,000 divided by 145 equals a little bit 3,200 shares. So I have an order, which is so price and number of shares, and then I have a stop. And now I got my trade. And that is how I do a get on a plane trade. Market opens down 300 points tomorrow. I will not be filled. I have to trade above that PSAR dot. Market opens up, gaps up 300. I may not be filled either. But if the market has an orderly move up, I will be filled. I'll have an immediately stop placed, and I'm risking 5.2% if the market immediately turns and runs against me. I think it's a safe trade. It's one of my favorite trades, and I don't know anything about WNS, but I have a stock in an uptrend at a base, close enough that I could take that 50-day moving average as my support, and if it breaks above that PSAR dot, I think it runs. That's the whole point of this scan. PACCAR, Gildan Activewear. What a beautiful looking chart. Don't know anything about their close. Earnings per share kind of suck. Multiples kind of high at 32. Teeny weeny yield, 0.8. Big uptrend. And despite a sell-off in the market, it had a mobile breakout from a squeeze. And I could do the same thing. I could look at this stock and say, my buy stop's going to be above that dot. My stop's probably going to be most likely below the low of the day here. And if that's too tight, I could look all the way down to the 50. So just for argument's sake, my buy price is going to be about 34.15, and the 50 is at 32.39. Yeah, it's about, I could probably put my stop down there, which is probably too much from a rationale perspective. Probably better off to put it here. But here's another trade that looks like it's reasonable. Again, I'm not saying I want to buy this. It's extended. I don't like its earnings per share growth. I'm saying that it meets my criteria to do a get on a plane trade. Toro Company, not yet. Med Assets, here's another one. Uptrend, sort of a cup here. Double intermediate bottom around here. Breaks above this PSAR dot. I put my stop somewhere below here. And I've got another stock that looks good. So these are all preset scans that I've put into HGSI. I have other favorites like Gallardi Sprinters, and I'll typically go through these. This is one of my favorite stocks and one of my holdings, and was the one of the examples I used in my A trade of how I took the trade and how I managed it. And this one had a good week despite the market selling off. This is Horizon Pharmaceuticals. If you don't think it looks good there, just take a look at weekly here. And it gave us great buy signals at the beginning of the year, and it's doubled, more than doubled since that time. And if you go back there, you could see the stock had been basing for ages, and it kept coming up on my scans. And here was the day to buy. I wasn't that good. All right, I bought it a little bit later, but I've made a nice return on this with my position. So I look at a lot of these to build my list, and then I bear down. Now, a lot of folks have been asking me, what am I doing with John's stuff and how do I use it? So in a nutshell, this is my analysis paralysis that works for me. Every weekend, I put together a super crazy watch list. This is my super crazy watch list. It includes a bunch of groups from TradeStation, from Investors Business Daily, from MarketSmith, from Metastock, from HGSI, some of the smart groups. And then what I do is I roll them all up into two groups. One I call my consolidated buys, which was 860 stocks this time, and one I call my top 15 stocks, which was 366. Now I take that consolidated buys list and I add the S&P 1500 to it, and here's my fishing pond. 1,754 stocks. Now, I'm not going to look at 1,754. I'll come back to that number. I do take and create something called my weekend bulls, and I take that top 15 list, I take the MarketSmith 250, and then I take the top stocks from those scans we just looked at. I looked at every one of those, and I look at every one of those every Sunday. Now, during the week, I don't have time for that. I do the scans I just showed you, but the way that I've taken advantage of what I've learned from John is I basically created a couple of scans within TradeStation. And what we're able to do is look for his, and let me go down to my roll-up list. Here's my roll-up list. I can look for high close dojis in my roll-up list. This is probably his best signal to take to go long. Now, to be a real high close doji, your stock has to be in a downtrend. So even though Skechers is up here, it'd be pretty tough to cause Skechers to be in a downtrend. However, let's just take a look at the high close doji that we saw on, I haven't looked, so I could be AT&T. So a high close doji is defined as you have a doji bar in a downtrend, and I think that in a longer period of time, let's just switch that to a weekly real quick, or a monthly. AT&T at best is sideways in a monthly chart, and on a weekly chart, sideways. So AT&T is a sideways stock who's had a short-term pullback here. Go back to my daily. And had a doji bar. Its on-balance volume is going up. These are my indicators. I'm going to leave them alone right now. And this is a high close doji, which is a close above the high of the doji bar. Now, John has trading rules that define the stop and the target, when to take the trade, and how long to give it from a time stop to make a move. These are high probability trades, and they often move in a short period of time. So the point of this was not to steal John's stuff and teach it to you so you don't have to learn it from him. Go buy his books, take his courses, buy his products. But to show you that I can take that big list and I could scan it looking for high close or even low close dojis. And a low close doji, like here, is a close below the low of the prior doji bar in a stock that's been in an uptrend. I can look at high and low close dojis from a weekly perspective. So here you have a doji bar and a close above it, so that's a high close doji. Ignore the label on the bar. Then John has a number of unique buy and sell signals. So I'm able to scan my entire list, and I can find stocks like Eli Lilly that we talked about that are actually in a buy signal. So I can scan for weekly buy, for daily or weekly buy signals, and I can look at my top list of stocks. So what I'm able to do during the week is I'm able to rapidly scan multiple signals on my favorite stocks, and then create a super watch list of typically 100 stocks on a weeknight that I could look at in about a half hour. And as I showed at my meeting, I can get my evaluation down in about 40 minutes during the week. I also have a number of scans that include a number of my favorite indicators within HGSI. And here's Progressive Software that had the Bible gap up and a person buy signal the day before, big OBV increase. So I've tried to marry the best of HGSI with the John Person tools. And if you are an HGSI user and you either have purchased John's lifetime package or are interested in learning more about it, feel free to email me because we're launching a new HGSI called the PUG group, which would be HGSI users who are also Person users. And we're going to try and work together, get John's help a little bit, but try and build a better way of finding great stocks together in a users group. I'll be sharing with you in the users group all the different tools that I can, and perhaps as groups we may actually bring in, as a group we may bring in some programmers to help program things that we as a group think would be useful. Bottom line is, it's an opportunity to work with a modest-sized group on a regular basis using the same tools, and only open to people that have HGSI and Person's lifetime tools and TradeStation, except if you attended one of my recent live meetings in person and were a paying attendee when I opened the membership to you as well. So on that note, I'll say goodbye in 1 second. Now, if you're sitting here going, that's not fair, I want to do Person stuff, but I can't afford his material, I hear you. So what I'm going to recommend is you go play a little bit with Thinkorswim. Because in Thinkorswim, for example, you can build your own scans, and John's indicators, at least his buy signal and sell signals, are built into Thinkorswim. So I could scan the market and look for stocks that are above 250 and 200,000 that have a daily buy at a squeeze and hit scan and see if anybody came out. And then these might be stocks that I might want to take a look at further. So I know Med Assets showed up on a number of things that I did. So let's take Med Assets into the chart view and take a look at Med Assets. And now let's see if we can put it into a more of a, let's see. Okay, here's the time frames I like. And so I see a number of things here. Let me just show you what I'm seeing here. This blue arrow, you can double click on it. It's a PPS buy signal. I should see a PPS buy signal. And these are some indicators that we've gotten in the HGSI community from Bob Meager. And rather than paint up my chart, which I've got enough stuff on my chart anyways, I'm able to use the labels without the indicators. So I've got a stock that was up 1% on a bad tape, traded near the high of the day, on volume above normal, had a MOBO breakout from a squeeze, both force indexes are positive, and had a bongo buy, and it's showing strength on a high volume up bar closing on the high. So this might be a stock I want to look at more closely. So the point here was not only can I chart things like John's indicators, but I could also scan for buys and sells. And how about sells at a squeeze? Did any of those make the chart? Don't know anything about SYN except it's too cheap for me to look at, but I'll look at it very quickly just to show you that it should show me a sell signal, weakness confirmed on down bar. So it's got a MOBO breakdown, Kahuna force to the downside, bongo to the downside, and here's a stock that's breaking down. It's probably too cheap for me to even look at from a shorting perspective, but I certainly wouldn't want to buy it. So on that note, I think I've spent enough time. I hope you get something out of this. If you have more interest about our HGSI Pug user group, email me at hgsidoc@gmail.com, and we can tell you more about the packages that John has and how I use them. And look forward to the first. These are online meetings. There's no charge to participate. If we decide that we have to get something programmed for all of our use, those that are interested will share on the programming. And if I lose access or at some point I need to get a different web-based meeting program, then we'll split the monthly cost of those as well. Y'all have a great week. Let's be careful. We might have a head fake and have a market that starts out down and turns around before the end of the day. We've seen crazier things. I don't think it really matters in the long run what happens to Greece. And maybe we'll also start to pay more attention to Puerto Rico. Goodbye, everybody. Have a great weekend and happy 4th of July. And to those that have served, thank you for your service.